Finance Limited Q1 FY27 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. We have with us today Mr. Sudipta Roy, Managing Director and CEO, Mr. Sachin Joshi, CFO, Mr. Raju Dodti, COO, and other members of the senior management team. Before we proceed, as a standard disclaimer, no unpublished price-sensitive information will be shared during the call. Only publicly available documents will be referred to for discussion during the interaction in the call. While all efforts will be made to ensure that no unpublished price-sensitive information will be shared, in case of any inadvertent disclosure, the same would, in any case, form part of the recording of the call. Further, some of the statements made on today's call may be forward-looking in nature. A note to this effect is provided in the Q1 results presentation uploaded. I would now like to invite Mr. Sudipta Roy to share his thoughts on the company's performance and the strategy of the company going forward. Thank you, and over to you, sir.
Thank you. A very good morning, everyone, and thank you for joining us today for the Q1 FY27 investor call of L&T Finance. Joining me on the call today are our Chief Financial Officer, Mr. Sachin Joshi, our Chief Operating Officer, Mr. Raju Dodti, along with other members of the senior management team of L&T Finance. Similar to our previous earnings calls, today's discussion will be divided into two sections. I will begin by sharing my thoughts on the macroeconomic environment, our business performance during the quarter, and the strategic priorities under Lakshya 2031. This will be followed by our CFO, Mr. Sachin Joshi, who will take you through the detailed financial performance for the quarter. Post our commentary, we'll be happy to take questions on the call. Before we delve into the highlights of the quarter, I would like to give you some flavor of the current macroeconomic scenario and sectoral outlook, which becomes important given the volatility in the geopolitical arena and the impending worries of an uneven monsoon coupled with the impact of El Nino. Over the past few months, the global economy has had to navigate geopolitical uncertainties, non-stop fluctuations in energy prices, disruption to supply chains, and changing trade dynamics between major economies. While these developments have introduced a period of volatility, India's macroeconomic fundamentals have continued to demonstrate resilience. The economy has performed better than expected throughout the year, while posting a growth of 7.8% in the fourth quarter of FY26, supported by healthy government capital expenditure, improved infrastructure creation, and resilient private consumption driven by a recovery in rural demand. On the demand side, private consumption aided by discretionary spending has remained resilient so far, supported by both rural and urban demand. Structural reforms, favorable financial conditions, and the government's thrust on infrastructure spending have aided investment activity and bodes well for sustained strength in demand conditions. The market is exhibiting strong credit growth momentum as some sectors like microfinance have emerged from a prolonged period of contraction, and most other sectors see a healthy uptick of consumer demand. Strong growth impulses are reflected in credit momentum as well that has picked up in recent months. Tailwinds from regulatory and government measures introduced in FY26 are expected to support credit demand going forward. On the rural front, the progress of the southwest monsoon has remained an area of close attention for the entire financial services industry. While the season began with some regional variability and intermittent rainfall patterns, we are encouraged by the gradual improvement in monsoon activity over the past few weeks, with 70% of the country reporting normal or high rainfall in July. Rainfall in the first week of July 26 was 48% above the normal level, and cumulative monsoon deficit till 10th July 26 had reduced to 14% below the long period average. Mandi arrivals of Rabi crops are running 8% higher, and government procurement for kharif crops has seen a massive surge. I'd like to call out that the market concern we have seen regarding onset of El Nino and its projected impact on the monsoon. The L&T Finance team has extensively traveled in rural geographies in our core markets over the last few weeks, and we see normal economic momentum. While the onset of the monsoon was slightly delayed, economic and agricultural activity remains strong, and current reservoir levels are sufficient to sustain normal agricultural output and hence protect rural cash flows. We remain hopeful that rainfall will continue to catch up during the balance of the season, supporting agricultural output, rural cash flows, and overall consumption. Encouragingly, rural demand indicators continue to remain resilient, aided by healthy government spending, continued infrastructure investments, and sustained focus on the rural economy. We are confident that resilient domestic demand and coordinated policy support will provide the wherewithal to withstand the adverse impact of such uncertainties. Coming to this quarter's highlights, I'm pleased to share that L&T Finance has delivered another strong quarter of profitable and quality-led growth. During Q1 FY27, we recorded our highest ever quarterly consolidated profit after tax of rupees 902 crores, representing a growth of 29% year-on-year. Our consolidated book crossed another important milestone, reaching 1,29,634 crores, reflecting a healthy year-on-year growth of 27%, with an ROA of 2.48%, reflecting a growth of 11 basis points year-on-year. This has been achieved on the back of robust quarterly retail disbursements of rupees 23,852 crores, up 36% year-on-year, with contributions from all our lines of business, demonstrating the continued strength of our diversified retail franchise. The significant thrust in our disbursement momentum year-on-year has been a result of a continuous focus on building granular distribution channels, our ever-expanding branch footprint, expansion of our digital acquisition capabilities, duly supported by our AI-powered next-gen credit administration framework, Project Cyclops, and our continuous focus on strengthening risk guardrails, allowing us greater confidence on quality underwriting. In the last call, I had emphasized upon our trajectory of paring of credit cost on account of implementation of structural credit policy measures in our businesses and the realization of positive dividends from the early implementation of Cyclops in two-wheeler, SME, and farm businesses. I'm pleased to inform you that consequently credit costs moderated to 2.54%, reflecting another quarter of sequential improvement of 10 basis points, supported by our continuous focus on strengthening credit administration, collections excellence, and AI-led portfolio management. A strong growth of 29% year-on-year in total income, with a PPOP growth of 35% year-on-year, was largely driven by sharp focus on managing yields across businesses, fee improvement, and efficient liability management. Stable NIM plus fees at 10.47%, despite a competitive operating environment, further demonstrate the resilience of our business model. This has resulted in our ROE improvement to 2.48%, while ROA increased to 12.71%. While these numbers are robust, I would like to emphasize that we could have grown even faster. However, given the volatility in the economy, we chose prudence over aggressive expansion, maintaining our emphasis on responsible growth, disciplined underwriting, and superior portfolio quality. We proactively tightened our credit guardrails during the quarter, deliberately letting go of about 1,000 to 1,200 crores in potential disbursements, foregoing a few percentage points of additional growth to firmly protect our asset quality. It is important to note that through our Lakshya 2031 asset growth target is 20% plus CAGR over the 5-year period, whenever the market and credit conditions are conducive, we would use that opportunity to grow our asset book in a risk-calibrated way at a faster pace than Lakshya goals, as has been the case during this quarter. However, we will never compromise risk for growth as articulated in our risk-first, tech-first approach. I would now like to share an update on our Lakshya 2031 goals, which marks our pivotal leap from transformation to delivery. As many of you would recall, during our last earnings call, we formally launched Lakshya 2031, our 5-year strategic roadmap that marks our transition from institutional transformation towards sustained delivery. I'm pleased to state that we have begun this journey on a strong footing. While our profitability metrics continue to improve quarter after quarter, our immediate focus remaining on maintaining consistency and execution. We recognize that Lakshya 2031 is a 5-year journey, and therefore our endeavor remains focusing on delivering sustainable growth while steadily improving credit cost, profitability, and returns over the course of this strategic plan. We have set ourselves a book growth target of CAGR of 20% plus over the Lakshya period. As explained above, I am pleased to report that we are tracking well in line with this target, achieving a robust 27% growth in Q1 FY27. This was supported by strong disbursement momentum across all our lines of business, secured as well as unsecured products, with a 126% year-on-year growth in personal loans, a 41% year-on-year Cyclops-powered growth in two-wheeler finance segment, a 24% year-on-year growth in rural business finance, a 22% year-on-year growth in housing loans, a 23% year-on-year growth in SME finance disbursement, and an 11% year-on-year growth on farmer finance disbursement. Notably, one of the most important developments during the quarter has been the continued collection efficiency normalization of our rural business finance portfolio to pre-crisis levels, which has given us the confidence to resume the growth trajectory of the business, albeit within the MFIN guardrails and our proprietary risk administration frameworks. We have started the work of implementing Cyclops in our RBF book vertical, and it is expected to complete before the conclusion of FY27. Across our urban business lines, we continue to maintain our sharp focus on sourcing undiscovered prime, and prime plus customers who exhibit strong credit resilience. This disciplined approach has led to our prime customer share in our two-wheeler finance disbursement steadily increasing to 90% for Q1 FY27. Our journey towards building a prime-dominant urban portfolio that showcases true resilience across business cycles continues unabated, firmly underpinned by our robust credit and risk administration frameworks. Secondly, on the credit cost front, we'll endeavor to drive credit costs down to a level of 2% or less during the Lakshya period. Over the last few quarters, considerable effort has gone into strengthening our underwriting framework, collections infrastructure, and portfolio monitoring capabilities. The continued moderation in credit costs and improving asset quality during the quarter provide us confidence that the structural interventions are delivering the intended outcomes. Additionally, we have commenced participation in the central government's credit guarantee schemes, namely CGFMU and CGTMSC, to create an incremental safety net for select cohorts of our rural business finance and SME portfolios and shield the balance sheet from cyclical volatility. We believe that there is still a significant headroom for further improvement. As our newer portfolios continue to season and our proprietary AI-led underwriting and portfolio intelligence engine mature further, we expect our asset quality to strengthen progressively over the coming quarters. This remains one of the most important levers for improving our profitability metrics under Lakshya 2031. Our return on assets target remains in the range of 3 to 3.2% for FY31. Against that, we recorded an ROA of 2.48% in Q1 FY27 versus 2.37% in the corresponding quarter in FY26, also up 11 basis points year-on-year. We remain committed to working on achieving the 2.8% ROA threshold in Q4 FY27 as communicated earlier. Against a Lakshya 31 ROE target of delivering a return on equity in the range of 16 to 18% by FY31, ROE increased to 12.71% in Q1 FY27 from 10.86% in Q1 FY26. As we look ahead, we have identified 3 key strategy objectives for FY27, namely, number 1, driving cross-sell and upsell, number 2, productivity enhancement, and number 3, embedding tech DNA across the organizations. These capabilities are critical to achieving our short-term and long-term business targets while building sustainable capabilities for future growth. LTF has one of the largest customer franchises in the BFSI sector in India, totaling to 3 crore customers, and we see significant opportunities to deepen relationships with this large available pool. Cross-selling remains a major focus area for us under Lakshya 2031. We're trying to reinvent the traditional cross-selling approach through the use of a proprietary multi-agentic framework, which will help us identify, originate, and fulfill cross-sell workflows to leverage the large customer base. We'll give more details on this later during the call. Secondly, we continue to drive productivity enhancement across all our lines of business, primarily focused on frontline employees to customize productivity dashboards. Third, in line with the strategic objectives of embedding AI-empowered tools and processes, we have taken the task to inculcate a tech DNA in all parts of the organization to build a future-ready workforce. This would entail identifying AI champions across the organization to help proliferate the use of applicative AI directly into everyday activities. As I've highlighted in previous quarters, our strategic investments in proprietary AI tools spanning hardware, software, and market-leading talent remain foundational to how we sell, underwrite, collect, and operate. These strategic objectives are central to our structural evolution into a risk-first, tech-first, AI-native, multi-product retail financier of choice. As we start our Lakshya 2031 journey, our objective is no longer to be merely an AI-enabled lender. Our aspiration is to build India's leading AI-native retail financial services institution. What differentiates our approach is that we have consciously invested in building proprietary technological capabilities. Rather than deploying isolated AI use cases, we have architected an integrated intelligence platform that spans the entire lending lifecycle, from customer acquisition to underwriting to portfolio management, servicing, collections, and customer engagement. This was articulated as our technology vision statement during the Investor Digital Day in November 2024, and we have continued to execute the envisioned architecture in a disciplined fashion. Today, 2 years later, we are pleased to share that our technology platform is powered by 1,000+ technology and data science professionals who have built an in-house deep tech stack around customer intelligence, credit intelligence, portfolio intelligence, and service intelligence. The same has been built out on an open API and microservices-based architecture, leveraging 100+ proprietary scorecards, 7 alternate data channels, and unified customer data governance platform. The first leap of faith in this journey was architecting Project Cyclops, our next-generation AI-powered 3-dimensional underwriting engine, which now serves as a prime example of effective technology driving growth and building resilient credit quality. Cyclops has now been operating for 2 years in our two-wheeler business, has underwritten a portfolio of more than 12,000 crores, and consistently outperforms industry risk benchmarks by a wide margin. To illustrate, performance of Cyclops in our two-wheeler portfolio has been outlined in slides 13 and 14 of the investor presentation. Project Cyclops is also live in our firm, personal loans and SME businesses, and exhibiting excellent headline incomes. We'll make those outcomes public as and when we cross the seasoning threshold of 24 months. We intend to take Cyclops live in our rural business finance and mortgage businesses during FY27. Nostradamus is our second proprietary tool completely built in-house to enable enterprise-wide portfolio intelligence. Nostradamus is currently live in two-wheeler and personal loans in a beta mode, and we intend to implement this for our RBF, SME, and farm businesses in FY27. This platform is already delivering measurable outcomes in predicting and containing portfolio risk at a granular micro-market levels in our two-wheeler finance business, enabling our business teams to undertake automated stress testing, generate real-time collection actions, and proactively identifying emerging portfolio risks significantly earlier than traditional monitoring frameworks. Our new initiative is to rapidly democratize AI across the organization. Rather than limiting AI capabilities to a central technology function, we are embedding intelligence directly into day-to-day workflows of our operating teams through a growing suite of proprietary AI co-pilots. Our flagship underwriting co-pilot, Helios, has already processed approximately 39,000 underwriting files and materially reduced turnaround times across SME finance and home loans. Orion, our conversational portfolio management co-pilot built on Project Nostradamus, has already serviced more than 3,000 business queries, enabling faster portfolio insights for our operating teams. Shighram has automated more than 4,000 mortgage legal files across 11 vernacular languages, while our mortgage policy and pricing assistant today services more than 200 business queries every day across 15 Indian languages. During the quarter, we also launched Argus, an AI-powered fraud screening engine for SME finance, further strengthening our risk management capabilities. Please refer to slide 16 of the investor presentation for further details. Another significant milestone during the quarter has been the rollout of Canyon, our proprietary AI-powered loan origination system for gold finance. Built entirely in-house in under 4 months, Project Canyon combines more than 16 integrated systems, over 60 APIs, 12 business services into a scalable architecture capable of nearly supporting 30 times future business growth. More importantly, nearly 60% of its code base has been generated using AI-assisted development tools, demonstrating how AI is increasingly transforming not only our lending decisions, but also the way we engineer technology itself. The platform's embedded agentic AI assistant, Genie, together with the context-aware asset capture and microservices architecture, is already enabling faster turnaround times and superior customer experience while providing the flexibility to rapidly respond to future regulatory and market changes. Please refer to slide 17 of the investor presentation for further details. As I mentioned earlier, I'm pleased to announce our next-gen agentic AI-based service and cross-sell platform, Hercules, which is being built completely in-house. The platform is designed to deliver hyper-personalized customer experience at scale. At its core, Hercules leverages a central data repository to build a comprehensive customer golden record. This unified data feeds into an advanced AI decisioning layer, utilizing predictive analytics and propensity models to dynamically generate precise next best offers. Here, we are integrating agentic AI into our code orchestration layer to autonomously manage lead identification, origination, and fulfillment while executing the hyper-personalized engagement through all our customer touchpoints, our Planet app, WhatsApp journey, or outbound voice bots. By unifying our lead management and load origination systems into this intelligent omnichannel ecosystem, Hercules will significantly elevate service excellence, drive operational efficiencies, and maximize cross-sell velocity across our entire portfolio. We are targeting rollout of this platform by Q3 FY27. To support the exponential growth of this in-house AI capabilities, we are investing in our own private cloud build-out. Crucially, the strategic transition to an open-source private cloud will be 70% cheaper than relying on hyperscaler clouds over a 5-year total cost of operation. Concurrently, to support our intensive ML and AI workloads, specifically for running open-source LLM and SLM packages, we have initiated the design and procurement of high-performance GPU server augmentations. Moving forward, we are aggressively prepared for massive cloud consolidation, targeting the migration of workloads from public to our internal private cloud infrastructure starting in Q3 and Q4 of FY27. By continuously strengthening this foundational infrastructure, we are unlocking 3 critical outcomes for the organization, driving sustained growth, ensuring improved credit quality, and achieving significantly reduced OPEX. Please refer to slide 18 of the investor presentation for further details. We believe that these capabilities will progressively improve customer acquisition, strengthen portfolio quality, and reduce operating cost and enhance operating leverage over the coming years. As our AI models continue to mature and our proprietary data ecosystem expands, we expect technology to become an even stronger competitive advantage for L&T Finance. We firmly believe that this AI-native operating model will also become one of the defining competitive advantages of L&T Finance under Lakshya 2031. Now, I would like to give you a brief update on the scale-up of our gold loan business. Following the successful implementation and acquisition and integration of the portfolio last year, our focus has been on rapidly expanding our distribution footprint. During the quarter, we expanded our Gold Finance network to 343 branches, adding more than 200 branches since the acquisition. The business has grown to a book size of approximately 3,800 crores, registering a growth of over 180% year-on-year. On the footprint expansion front, our speed to market remains exceptional. Following the launch of 200 branches in FY26, we are now working on deploying 500 new branches in FY27, accelerating our velocity to 1.4 branches addition daily. I will now request Mr. Sachin Joshi, our CFO, to take you through the financial updates.
Thank you, Sudipta. As always, I will be walking all of you through the financial performance of the company for the quarter. Consolidated NIM plus fee for the quarter stood at 10.47% versus 10.22% for Q1 FY26 and 10.47% for Q4 FY26. Consolidated PAT for the quarter has gone up by 29% to 902 crores. Quarterly retail disbursements stood at 23,852 crores, up 36% year-on-year. Retail book stands at 1,27,535 crores, up 28% year-on-year. Our consolidated book stands at 1,29,634 crores, up 27% year-on-year. Consolidated ROA stands at 2.48%, up 11 basis points year-on-year. Similarly, consolidated ROE at 12.71% is up by 185 basis points year-on-year. Talking about retail businesses, let me start with rural business finance first. The business registered quarterly disbursements of 6,961 crores, up 24% year-on-year, mainly on account of improved collection efficiency and sectoral trends. The book size reached 32,493 crores, up 22% year-on-year in the first quarter. Farmer finance vertical, the quarterly disbursement stood at 2,453 crores, up 11% year-on-year. The book size reached 17,514 crores, reflecting a growth rate of 11% year-on-year. The segment, which comprises two-wheeler, personal loans and mortgages, we call it urban finance, saw a 57% year-on-year jump in overall quarterly disbursements, 10,787 crores in all. As a result, the overall book size increased to 63,615 crores in the first quarter, translating into a 32% year-on-year growth. The two-wheeler business registered quarterly disbursement of 3,006 crores in the quarter, up 41% year-on-year. The book size increased to 15,068 crores, up 22% year-on-year. With 90% of June 26 two-wheeler disbursements in the prime segment, we continue to prioritize high-quality growth and optimize risk-adjusted returns. In the personal loan business, we achieved our highest ever quarterly disbursement of 4,380 crores, translating into a stellar growth of 126% year-on-year, with the book size of 16,917 crores, an increase of 80% year-on-year. In the mortgages loan business, we achieved quarterly disbursements of 3,401 crores, up 22% year-on-year. The book size reached 31,630 crores, an increase of 20% year-on-year. In the SME business, quarterly disbursements stood at 1,567 crores, up 23% year-on-year. The book stood at 8,884 crores, up 28% year-on-year. The growth in business volumes was aided through an increase in direct sourcing and an existing strong network of distribution channels. In the gold loan business, the quarterly disbursement stood at 1,928 crores, up 26% year-on-year. The closing book reached 3,829 crores at the end of the quarter, representing a significant growth of 182% year-on-year. Let me now hand over the call back to Sudipta to make his closing comments.
Thank you, Sachin. In summary, we are satisfied with our performance in Q1 FY27, where we are focused on relentless execution. With the significant investment made across technology, engineering capability, AI infrastructure, branch expansion and talent, We're expecting operating leverage to play an increasingly meaningful role in improving profitability, improving operating efficiency, which together with lower credit costs will be an important driver of ROA and ROE expansion over the Lakshya 2031 period. I thank you all for a patient hearing. The floor is now open to questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Kunal Shah with Citigroup. Please go ahead.
Yeah, thanks for such a detailed presentation and the opening remarks, particularly touching upon the entire AI initiatives. So, few questions. Firstly, in terms of the NIM plus fee, so overall it's still sustained at 10.47, but there has been a decline in the NIMs if we really look at it, while other income has actually gone up. So what are the components of it? Any impact of excess liquidity which would have been there? If you can just highlight what is leading to that kind of a deviation in NIM and the fee income and the sustainable trajectory. The second question is on growth. So particularly on the personal loan side, the growth has been quite strong. So if we can highlight some guardrails and the profile that we are keeping in mind just to ensure that asset quality out there is sustained. Well, at the same point in time, we had seen some slower disbursements on the SME and gold loans compared to that of last quarter. So is it something wherein you indicated that you have let go of some disbursements were this in these two particular segments? Yeah, those are the questions.
Okay, Kunal, thank you. Thank you for your comments. Let me first take up the NIM plus fee related point. This is Sachin here. So we can see clearly that the NIMs have reduced by 24 basis points from 8.78% in Q4 to 8.54% in Q1 FY27. The yields, if you look at, have actually gone up by 1 basis point, but our debt equity has been rising, which is leading to interest costs going up by 25 basis points. Actually, WACC is up just 3 basis points between the two quarters, moving from 7.17 to 7.20. But debt equity, which was 3.73x, has gone to 3.97x, about 0.24x higher. One reason is, of course, increased borrowing to fund the growth. And the other reason is also due to the geopolitical situation being a bit difficult on account of war in Iran. We had maintained slightly higher surplus liquidity of close to 4,200 crores. The overall liquidity was 13,000 crore plus. So the net result has been a reduction in NIM by 24 basis points. However, what is worth noting is that this surplus has been deployed in various instruments on which we have also earned an income and which has been booked under the head fee and other income. So when you look at the NIM compression, you should actually look at in totality, and that's the reason we always request analysts and investors to actually look at the metric of NIM plus fee and other income just to make a comparison, which has actually remained at exactly the same level. It's a coincidence, but previous quarter also it was 10.47. This quarter also it is 10.47. So there has this other income actually includes some of the surpluses which were deployed. The income is coming in that fee and other income. Correspondingly, the interest cost is part of the NIM. So that's the reason you see this difference. I hope I have answered the question.
Yeah, and besides this, there is no element in the other income.
No, there are
maybe any SR recoveries or something which is there, or maybe purely on.
No, so Kunal, the ARCs we keep, actually there is a fee which is paid to ARCs, but there are some times when we have small incentives and also other income. Nothing really worth, talking about. Let me put it this way.
Okay, thanks, Sachin. Kunal, on the growth question. Personal loans continue to, go well. and that is primarily because the thorough and disciplined execution of our implementations with the digital partners. Now you see, we have now got 4 digital partners, which is primarily Cred, GPay, PhonePe, as well as Amazon. And these are the main large ones. We have a couple of smaller ones as well, but these are the 4 main large ones. Now, what happens is that we have been sort of working on smoothening the digital journeys and sort of removing friction from our workflows consistently quarter after quarter. And because these are platforms which have a large number of customers, and we tend to focus on salaried customer, our objective is to build a large salaried personal loans book, right? So we focus on our salaried customers, and with a largely frictionless, optimized channel, as and when the visibility of our loan programs increase across these platforms, the volume tends to grow. Now, we have been adding partner after partner and optimizing this partner's velocity, so it has continued to grow. And we have been embedding Cyclops now into these journeys, right? And the fact is that Cyclops also has been embedded to many of these digital journeys. And so we are very, very confident of the credit quality that is coming through. First thing which I mentioned was that our focus is only on building a salaried, predominantly, we do loans to self-employed as well, but our focus is building on predominantly salaried book in our personal loans business. We have strong guardrails. Cyclops has been implemented. The credit parameters on the personal loan business, what it was 1 year back vis-a-vis what it is right now, there is a significant improvement. And the fact is, each and every parameter with every credit parameter with every passing quarter is tending lower and becoming better with every passing quarter. So as of now, we remain satisfied trajectory of this business. Yes, you have seen some heady growth in percentage terms because of the base effect. Last year, Q1 FY26, our disbursement, compared to the disbursement, our disbursement has grown definitely. But again, that is attributed to a much lower base. As the base grows larger, the percentage growth rates will reduce over the next couple of quarters. However, we remain committed to growing this business in a risk-calibrated fashion. On your question on SME and gold loans, yes, SME, we have been cautious during this quarter, primarily because, we were cautious about the fallout of the, West Asia war on certain business lines as well as certain sectors. So we have been cautious, and we sort of on our own cut disbursements in some of the SME sort of cohorts. So we have done that. Gold finance, again, April was a month in which the new RBI guardrails came into effect, where assessing customer basis a tiered loan demand became mandatory as per as RBI guidelines. And it is not only us, the entire industry saw an impact of adjustment to these new guidelines. As a result of that, we erred on the side of caution just to make sure that we are completely compliant with the RBI guidelines. So just like across the industry, some of the origination volumes fell. We saw a fall in our origination volumes in the month of April. However, there has been continuous improvement in May and June. I expect the gold loans business to have a normal growth trajectory in Q2 FY27 because the period of adjustment and learning in Q1 FY27 is behind us. So I hope that answers your question.
Sure. Yeah, that answers. Yeah. Thanks a lot.
Thank you. Next question comes from the line of Shreya Shivani with Nomura. Please go ahead.
Yeah, thank you for the opportunity and congratulations on a good set of numbers. First question is on the personal loan book itself. What I can see is that obviously the Cyclops was embedded into this in 2Q26, but your Nostradamus is only getting implemented in this quarter, right? Just wanted to understand how much I mean, I understand the control you would have had at the underwriting level, but without the monitoring AI engine, what kind of confidence do you have with the book you're underwriting? If you can give some color around, not in the terms of salaried, non-salaried, but in terms of what's the ticket size of the book that you've been putting out through these platforms. My second question is on the farm, the tractor business. Any color on the slightly slower trend over there? Were we cautious? Are we taking geography-wise focus because you've mentioned monsoon? Some states may have reservoir benefit, etc. Other states may not have those reservoir benefit, and if the monsoon is slower, we may get hit. And third is on the cost of funds in terms of what are we going to do going ahead? I understand the first quarter we were piling up liquidity, etc. But going ahead, what will be our strategy and how much release or
aggregate basis FY27, I think may go up by about 4 to 5 basis points on an overall basis. So yearly WAC may actually go up from 7.35% for FY26 to maybe about anywhere between 7.35 and 7.40. That's what we are currently envisaging.
Right. Okay, this is useful. Thank you so much and all the best.
Thank you.
Thank you.
Thank you. A reminder to all the participants, please restrict yourself to one question and rejoin the queue for more questions. Next question comes from the line of Avinash Singh with Emkay Global Financial Services Limited. Please go ahead.
Yeah, hi, Sumit. Good morning. One question is on your ROE journey in Lakshya 2031. Broadly, it expects kind of a ROA to improve 60 basis points from here on a pre-tax basis, 80 basis point kind of expansion. Now, over the journey, I mean, how do you see the contribution from credit costs and OPEX to come? Because by and large, it seems given the asset mix, the NIM plus fee is already where it should be. So, I mean, how do you see, this 80 basis point kind of an improvement to come from? I mean, of course, when SR gets kind of realized, probably that will release something. But rest, if you can explain that, okay, how this 80 basis point expansion in PBT ROE is going to happen. And particularly that in the backdrop, if at all, there is going to be something from the insurance regulator on the commission part, because insurance commissions are a reasonably healthy kind of a proportion of your fee income. So that's first question. And second, if at all, at this juncture, what's your reading on El Nino and its impact? If at all going to be on your rural portfolio growth and asset quality. I know it's too early and rains have been kind of improving, yet your assessment so far. Thanks.
Okay, thank you. I'll take the second part of your question first and then we'll come to the first. So, I've been traveling around quite a bit for the last 2 months, right? And frankly, I see nothing wrong in the economy. In fact, I was in Jabalpur about 3 weeks back, and wherever I went, in fact, a particular two-wheeler dealer, which is also one of the largest auto dealers in Jabalpur, he said that, he has had a record May and June, and he just doesn't have stocks. Right, I travel to rural areas also. Rural areas, things are okay. It's not that we could see any significant headline risk emerging. Yes, rains are delayed. El Nino is delayed. El Nino is supposed to, lead to a sort of lower than average monsoon. That is what is projected. But the fact is that if I look at till 10th of July, rainfall is only about 14% deficient. Now, the IMD projection is about 10% deficient, and if I look at what we have done is that we have also very carefully projected the reservoir stocks all across the country, and because of 2 back-to-back good monsoons, before this year's monsoon, I think the reservoir levels are at an acceptable level across the country, right? Barring a couple of locations, in South India, the reservoirs across the country are at an acceptable level. So, I do believe that even if we have a 90% monsoon, things are going to remain quite okay. Things are not going to fall out or break suddenly. And you have to understand one thing. The microfinance industry has come out of a major asset quality cycle. The microfinance industry has deleveraged from a peak book size of 4,40,000 crores to about 3,30,000 crores right now. Right, so the industry has deleveraged 1,10,000 crores, and you always remember that during a crisis period, your underwriting guardrails go up. So the book that you generate during the period is obviously of a much higher quality. So typically, after any asset quality cycle, you typically have a 18 to 24 months of Goldilocks period, where you really do not see any emergence of risk. In fact, in the microfinance industry, in spite of whatever El Nino worries, etc., have been there, I believe that it will be a pretty normal year, and I do not see any emergence of pockets of risk anywhere. The industry is being responsible. The industry is adhering to the MFIN guidelines. The number of customers with more than 3 loans outstanding, I think, is lower than 5% as of now, right, in the industry. So overall, the industry has deleveraged. So I think the worries on this are over time, right? So, and whatever our travels have told us, that the economy is robust, the economic activity is robust, and I expect that to continue. In spite of a little, maybe, monsoon can be a little subpar, but in spite of that, things will continue as normal. The tractor business, again, there might be localized disturbances, but overall, we expect us to have a reasonably normal year. And you would note that we had tractor business was the second business we implemented Cyclops after two-wheeler. So tractor business actually has been operating on Cyclops for almost 18 months now, right? And the headline results, like two-wheelers that we see of the Cyclops generated tractor portfolio, is quite good. And in fact, we had the first half-yearly collection cycle that went through on the Cyclops generated portfolio, and the outcome is quite good, right? So overall, we are reasonably confident that even if El Nino, etc., marginally impacts the rainfall, it will not have a very large impact on our portfolio, and we are sufficiently well capacitized to handle it because of our prudent generation as well as the collections framework that we have already existing in most of the areas. On your question on ROA and ROE trajectory, yes, we need to improve about 80 basis points. We are currently from whatever point we are currently there, we need to improve about 80 basis points to get into that Lakshya threshold of 3 to 3.2%. Now, all of that, I do believe that 20 basis points will come from the disappearance of the drag of the ARC portfolio, and that will happen over a couple of years from now. Many of the assets are resolving, but it's another 2 or 3 year journey for us. So 20 basis points will come from there. I do believe that about 30 to 40 basis points will come from efficiency in credit cost as well as credit-related costs, which I call the cost of credit administration, specifically collections cost, etc., and all that stuff it will come from. So that is where it will come from. Some might come from business expansion as well, right? A small bit can come from business expansion as well, and that is how it will stack up. Right? We are reasonably confident about achieving this, and by disciplined execution, we have been executing in a disciplined fashion so far, and it is our commitment that we'll continue the similar close, disciplined execution for the next 5 years during the Lakshya trajectory as well. Thirdly, on the question on insurance, etc., yes, we are aware of these developments, but I'd like to point out that it is not only, it is not only for us, it is for the industry. And I do believe that the insurance industry, along with the regulator and along with the end consumers of the insurance products, which is the BFSI industry, right, will come to some acceptable solutions and outcomes on this. That is also the reason that we have kicked off the build-out of our payments business, because, as you know, payments can be a large fee revenue generator, but it will continue to build for us, right? So it will be at least 2.5 years before, significant payment revenues are, fee revenue on the payments business are visible on our balance sheets. So it is in a build-out phase. We are cognizant of some of the headline outcomes that might happen because of that, because of sort of regulatory norming. And as a business, we have factored that into some of our plans, and we will respond accordingly. But however, I'd like to point out that it is more of an industry issue, and it is not an issue for L&T Finance alone. Sachin, you would like to take?
No, I think you know. If there is any further question on this ROA issue, then I can maybe talk about it.
No, thanks. Very clear.
Great. Thanks, Abhi.
Thank you. Next question comes from the line of Abhijit Tibrewal with Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, good morning, sir. Thank you for taking my question. Just two things. One is, while in the last question you just articulated what are the levers for ROE improvement, where you spoke about 20 bps coming from disappearance of the drag of the ARC portfolio. I think another 30-40 basis points where you spoke about improvement in credit costs and declining credit administration. So just trying to understand, I mean, will this also include some improvement that we will see in OpEx over a period of time? I remember you talking about scale building in some efficiencies, but the fact that you kind of continue to invest, we are building this cross-sell engine that you spoke about in your opening remarks. You are, I think, also building your private cloud now, which you mentioned over a period of 5 years is better or is more efficient. So on the OpEx bit, if you could just explain how is the trajectory looking like. And the other thing that you just mentioned, sir, is that you kicked off your payments business. So just trying to understand overall whatever we've seen of the payment business until now, it's not really been a business which has been accretive to ROAs for most organizations till now. So are there pockets where you're looking to operate where the burn in the payments business will be much lower? And the other thing is, until now we've seen most corporates, at least NBFCs, acknowledge that they're using the payments business as a funnel for customer acquisition. So if that is the case also for us, for which business is the payments engine going to act as a customer acquisition engine? Those two questions, sir. Thank you so much.
Thanks. The first question again on the ROA tree, obviously, we are trying multiple things at once. I will say it's like executing on all fronts. One, obviously, very important is the cross-sell engine, primarily because, as you all are aware, the acquisition costs of customers of selling products or deepening relationship with existing customers is probably 1/4 or 1/5 of acquiring a new customer. So in terms of acquisition cost, obviously it is value accretive. Obviously, from a risk perspective, also selling to a known credit seasoned customer from a risk perspective is also value accretive, right? Because it helps us predict the credit cost outcomes far with far greater degree of uncertainty than getting a new customer off the street. So from both sides, it's more value accretive. Secondly, obviously, OpEx is not limited to cost of credit or credit administration. Many of the agentic frameworks, for example, let's take this example, our underwriting copilot, or for example, the legal copilot like Shigram, right? Average time to underwrite or interpret, not underwrite, to interpret, in case of a micro lab business, to interpret into the title reports and the titles and do the proper title searches could take anywhere from 4 to 8 hours, right? Now with Shigram, that is down to 30 minutes to an hour, right? So like this, many of the tools that we have, for example, our mortgage copilot enables our sales guys to answer the query using their own prompt generation on the tool, right, rather than try to call back someone in the call center and try to get an answer to the query, right? Or for example, in our collections businesses, our self-cure rates is now as high as bot-driven self-cure rate is almost high as like 40% right now. Especially in the two-wheeler business, our self-cure rate has gone up from 10% to 40%. Now we are not using any human beings to do this call. We are only using machines, right? So overall, we expect that some of this technology sort of deployment will reduce the need for headcount, though headcount need to finally do the sale on ground, especially in the high touch and feel rural businesses will remain. But I do believe that a large proportion of our urban businesses will see efficiencies in headcount as well. So over a period of time, I see a normalization in headcount cost as well. It will not be very sharp in the next couple of years, maybe in the next 2 to 3 quarters, it will not be very sharp. But as we move into FY29 and FY30, the impact of all these sort of implementations will be visible in our headcount attrition as well. So in a way, it will be over the board across the organization, the private cloud that we talked about. Now see, it's a sort of, again, it's a leap of faith as I talked about. We are trying to build much earlier because the fact is that we have been trying to push the AI envelope much earlier than many other organizations. The cost issue that comes with large AI usage is also very, very well upon us. So the fact is that because we have understood that this is something that we need to address at the beginning stage itself, otherwise it might end up undoing all the good that you want to do from an OpEx standpoint, we are starting to move towards building our own private cloud. However, can we run tier 1 applications on private cloud? Probably the answer is no. But can we run our tier 3 and tier 2 applications on our private cloud? Probably the answer is yes. Right? But again, it has to go through a period of reliability testing, a period of operational effectiveness before we can sort of say it is a success. Overall, we are trying multiple things in multiple fronts. We are not leaving any stone unturned. Maybe out of that, 80% will be a success, 20% might not be a success. But however, we are very, very confident that if 80% are a success, that trajectory of ROI improvement that we have committed is more likely to happen, over the Lakshya 31 time frame, right? And we are very, very committed to it. In terms of the payments business, yes, I understand that payments business on its margin, if you're trying to build the payments business as a solo business, at times it might not be value accretive. We have people with deep payments expertise within the organization. I have done payments myself for 25 years of my career, so I really understand this business very, very well, right? And so our focus will be on parts of the payments business that are more value accretive, right, from a fee point of view, and we will slowly provide more color to it as we go forward. We tend to build a payments business which is agentic in nature because we have a lot of expertise on the AI front, especially on agentic AI that our engineers are now building. We have decided to leapfrog the entire sort of normal payment and move into agentic commerce. And we do believe that the movement to agentic commerce will unlock certain revenue dimensions that are not yet hitherto explored by the industry, on which, yes, it is our thesis. Now the question is, we are trying to implement this thesis. The thesis implementation might be a great success, it might be a partial success, or it might be a failure. We really cannot put our finger on it and say, but the fact is that given the experience that we are reasonably confident of success. So overall, over the next couple of quarters, we'll slowly start working on this business. And see, our business is not to burn money to try to get customers. There are certain organizations who give cashbacks on UPI, etc., burn money and try to get customers. That is not our model. Our model is to independently go, first and foremost, serve our own customers. And because we do not have a payment stack at this current point in time, there's an OpEx drag that we have trying to facilitate payments to our customers. Now, the first objective is to eliminate that OpEx drag by doing that thing ourselves in-house. Right? The second thing is to intelligently build solutions through the agentic commerce model, where our customers, as well as some maybe new to organization customers, might find benefit in those agentic commerce solutions and sign on to us in terms of the services that we provide. And last but not the least, we will test hitherto unknown developed areas, especially in the prepaid payments area, where we are very, very confident that there are revenue pools lying, especially in the fees front, which can be tapped very, very effectively by the organization. So payments will be a step-by-step build. It will not be a all-Russian build. It will be a careful, calibrated build, which will continue to build for the next 3 to 4 years, because this is something that we are committed to in long term as a goal for diversifying our fee revenues, and this is something that we will deliver during the Lakshya 31 period. I hope I have answered your question.
Yes, sir, that answers my question, sir. Thank you so much, and I wish you and your team the very best.
Thank you. Next question comes from the line of Chintan Shah with ICICI Securities. Please go ahead.
Thank you for the opportunity and congratulations on the quarter. So just firstly on personal loans again. So I just wanted to understand who are the key competitors and how does our yield stack versus peers? If you could help on that. And secondly, what differentiates us on the personal loan front, whether it is faster TAT or customer experience, and the sourcing would be largely digital only, I assume. So yeah, that's the first question on PL. And secondly, on AI investments. So could you just elaborate on your AI investments? So what is the current run rate of AI related cost and what proportion is variable based on the usage? Yeah.
Yeah. Okay. So on the personal loans part, our key competitors is actually everyone else in the BFSI sector, right? Who does personal loans? They are our competitors, right? Now there are models of operation, right? There are certain organizations, especially the large banks, who operate on their own customer base, right, and through the DSA channel. Right. For us, we operate on our own customer base through the cross-sell to our, credit seasoned, customers. We also operate marginally through DSA. If you see our DSA volumes are only 10% of our overall volumes. But the fact is that, a large portion of our origination is through the digital partners who have a very large pool of customers, as well as they're far more amenable to digital processes. They allow very fine customer selection primarily because they see a large amount of the customer data, right? And so they're able to give us a far more nuanced underwriting approach, especially on a joint scorecard development with target loss rate. So I exactly know what is the customer underwriting and what is the target loss rate. And the scale up has been primarily because of digital journeys and friction sort of removal across all our channels. Our average yield remains at about 16% and plus, though there are certain channels which deliver, because we operate across the spectrum, our DSA channel will probably operate at a far lower rate, right? Because DSA channel, we do prime salaried, so our DSA channel will operate between 12 to 13%. Some of our digital channels will operate at about 19%. Overall, our weighted average yield in the personal loans business is about 16% or 16% plus is our weighted average in the personal loans business. In terms of the AI implementations, now see, there are a couple of parts, right? The fact, for example, there are core builds, right? For example, the core build would be like a machine like Cyclops or a machine like Nostradamus, right? Which uses probably doesn't use agentic AI on a query basis. It uses agentic AI. For example, Nostradamus uses agentic AI based query system, but the core of the machine is built using machine learning, where actually you do not have token costs that much. But the fact is that you run that machine and you have a continuous model upgradation cost. Overall, we have spent roughly about 38 crores to build Cyclops, and overall we have spent roughly about 33 crores for Cyclops. Nostradamus and 37 crores for Cyclops. But the fact is that we are still in the process. For example, as I said, for microfinance as well as the mortgage, Cyclops will be implemented this year, and Nostradamus will be implemented for other lines of business apart from personal loans and two-wheelers. So the cost on that continues, right? Overall, our token consumption, as we had given out some token consumption in the last part of last presentation. I think, if my memory serves me right, 240 crore tokens was the consumption, last quarter. Now, obviously, we are on Google Cloud, and we are completely a Google Cloud, GCP suite user. So obviously, we have a sort of a preferential deal with Google on usage of some of the AI tools, though we use Cloud Code for using some of our coding. See, right now I would say probably we can come back offline saying that what proportion of our total IC cost is variable AI cost. We can come down offline too, because I don't have that exact number available with me today. However, our overall IT cost is between about 100 to 120 crores a quarter is our overall IT cost trajectory. right?
To add the Cyclops, Nostradamus, and all these new projects that we are working on, the total amount, taking into account the previous year capitalizations also is around 102 crores at this point, and there is some work in progress, capital work in progress, which is there for the projects which we are currently working on.
Yeah.
Sure.
So hope that answers your question.
Yeah, that answers, and probably I'll connect offline for the fixed and variable portion. Sure. Yeah. Thank you. Yeah.
Thank you. Next question comes from the line of Abhishek Murarka with HSBC. Please go ahead.
Yeah, hello. Am I audible?
Yeah, you're audible.
Yeah. Hi, Sudipto. Hi. Congratulations for the quarter. So my question is on this wholesale NPA. So this is a quarter where after many quarters it has gone up a bit, although it's a small amount. But the question I have is, one, if I look at the wholesale book of 2,000 crores, how should we think about the health of that book going forward? Second is, in your guidance of credit costs coming down, have you factored any NPA coming from that book? And if not, then does that lead you to sort of rethink your guidance? And if you can share some color on the remaining book. I know it's small, it's just 2,000 crores, but just that, any kind of color on the health of that book will be useful.
Abhishek, let me take this, Sachin. Yeah. The GS3 small increase that you are referring to is actually part of a settlement that we have already done, and whatever hit is to be taken has been already factored in. So there is no further increase. It's actually transitioning between the 2 quarters. That's the reason why it is appearing as a GS3. But you will see the same amount actually getting knocked up in the next quarter. As far as the other assets on the books are concerned, they are all standard assets, so we do not really expect any hits coming out of that. On the ARC resolutions, we already spoken about in the previous quarter, but let me just add the positive side of it. The PCR on the SRs, the security receipts, when we started off on this resolution process was 58%, and that has now actually gone and increased to 68%. And the reason for that is that as per the RBI regulations, till the time all the assets domiciled with an ARC, till the time all the assets do not get resolved, any receipts out of resolutions of the other assets need to be actually kept as part of that ARC's reserves. So whatever resolutions are yet to happen, this goes and adds to that buffer. So 10% increase itself shows that there is a substantial buffer which has got created, which is actually not required because we do this mark to market on a regular basis. But we have that money, and that's why we are very confident that once the resolutions start happening, ARC by ARC, you will start seeing these credits coming into the P&L. And our assurance has been that we will not take it to the P&L, but we will utilize them to create macro-potential provision.
Right.
So I think that should give enough comfort to all of you.
So sure. So that is on the SR part. In the existing wholesale book, it's all standard. But in your guidance of credit cost, have you factored any slippage from this book, or it is purely just the retail movement and this book is too small and it will run off? So
no. Yeah, it will just run off over a period of time. That's right.
It's not factoring anything.
Abhishek, I will add to what Sachin says. Some of these assets, etc., who are in the ARC, we have seen significant movement in the resolutions. Without naming the asset, one particular asset which was in Bangalore got resolved in terms of the deadlock that was there between the developer and developers, and then it has got launched. The project is getting launched, right? And that project will take 3 years to finish. It's a massive project, right? So the cover on that particular is almost 3 times that we have, right, in terms of current valuation. So most of these projects will take the next 2 to 3 years to resolve, and our wholesale team, especially our resolution team, has reasonable confidence that over a period, during the Lakshya period, we'll end up getting a good amount of over realizations than what the book value of some of these assets are. And as we have committed, we will not take any of the realizations from the book of the over realizations on the asset into the P&L. We'll try to create a buffer if we get that particular opportunity. And as Sachin said, we are already getting resolutions some of these assets which have gone into their asset pool, because their asset pool has a couple of other assets, that cannot, that particular asset pool cannot be closed. So it shows up in increased PCR on the overall asset pools. So, but again, to reiterate, the credit cost assumptions does not assume credit costs from as of now from any wholesale.
Because the GS3 has only one asset, which is Supertech, which the PCR currently is at about 61%, and we believe, because we keep doing this fair valuation every quarter, and there has been no further requirement to make any further provisions, and that's the reason there is no need for factoring, and hence it has not been done.
Okay, very clear. Just another quick question on this dual group loans. The distribution network slide, right? So there, the distribution network villages activated. That is a flow number or a stock? Because it has gone down 5,000. 5,000.
This is on what, slide 25?
Slide 25, yeah. This is
what is the
a
question?
flow number, right? Every quarter, the number of villages.
Yeah, it's every quarter. See, what happens is that every quarter, what happens is that we have 220,000 villages into which we go and distribute our microfinance products, right? Now, some of those villages become inactive, in a quarter. So, the objective is to go and activate it once again, right? So, this number is new villages which are activated, which have been absolutely brand new villages where, previously we were not distributing, or a village where we were distributing prior to that, but the fact is that had gone, become inactive, which we have gone ahead and activated once again.
Got it. Yeah.
So this is a monthly exercise.
Monthly. Okay. Got it. Okay. Thank you so much, and all the best.
Thanks.
Thank you. Next question comes from the line of Viral Shah with IIFL Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and congrats for the good set of results. I had actually 2 questions predominantly. One was, Sachin, just a clarification on 2 points. You mentioned about the liquidity part initially you had at the beginning of the quarter. So when you look at the LCR numbers between the 2 quarters, that shows a decline already of 18 percentage points. So is that during the course of the quarter it was high and then towards the end of the quarter it was reduced?
That's right, Viral. Because we, as the situation starts improving, we really do not need to keep the conditions. Like, just a day back, again, there has been some increase. So the ALCO has given the authority to the management committee, which is a subset of ALCO, to take this decision on increase or decrease in the liquidity to be kept on the books. Because, ALCO cannot keep taking these decisions on an ongoing basis. They meet once a month. So they have been given the authority to actually keep moving in and out. If there is a need, if there is an external environment change which necessitates increasing the liquidity, then it is done. And it's a basically very proactively dealt situation. So the management committee actually meets every week to take care of this.
Got it. And second, Sachin, clarification I wanted was on the cost of fund side, you mentioned that you expect on a full year basis, say around 5 to 7 bips kind of an increase for the full year. When I look at F26 numbers, the cost of fund was 7.35 and 1Q we are standing at 7.2. So does it mean that from 1Q levels the cost of funds will go up by nearly say 20-25 basis points?
That is what we have budgeted for. But like if you had asked me the same question before the credit policy, I would have actually added 5-10 basis points more because the situation was grim and there was an expectation. See, the geopolitical situation is leading to global changes, right? And if the yields are going to go up internationally, then you have even Indian government and the regulator will have no choice but to keep increasing the yield just to remain competitive. As things stood just 2 days back, the yields actually came down again. And last 2 days again, there has been some challenges again between Iran and US. So it has been a very volatile kind of situation. So we have for the time being been very conservative and assumed that there could be 1 or 2 rate increases which may happen. Even if the repo rates don't go up, players like us get impacted negatively or positively depending on how the short-term yields really go up or down. So the short-term yields go up without even change in repo rates, and we have no choice but to keep borrowing. That actually leads to increase in the costs, which happened in the previous quarter, right? 3 basis points is the increase that we are showing. I'm sure that the peer group companies who do not have the benefit of PSL may actually have a higher increase. But same thing happens when situation turns, favorable. For example, Reserve Bank of India has come up with the FCNRB schemes, and if we are able to mobilize huge amount of funds through that mode, ultimately it will be AAA NBFCs like us who will finally benefit because the monies will come to us for incremental credit to be given. So, the situation being very volatile, that's the reason I've said that it could be in the range of 7.35 or 7.4. But, if things really get normalized, then you may see a much more favorable number that we may come across in over next couple of quarters.
Got it. And just one last question, Sudipta, for you maybe. You have been guiding for the credit cost to structurally decline, and for 4Q FY27, you have been guiding now for 2 to 2.2% kind of a credit cost, and thereafter it will still further decline. So for F28, what is the full year kind of credit cost do you think you can deliver? Can it be, we can assume less than 2% credit cost?
See, Viral, I am not a soothsayer, so I can't my first port of call is to get it to between 2 to 2.2. That's my first port of call. Now the fact is that Cyclops has been effective. Cyclops has been delivering, right? However, we are all traveling through a geopolitical environment which is volatile. We have, certain worries on the monsoon front, though, I do believe that those worries are overdone, right? However, my first target is to get it to 2 to 2.2. उसके बाद देखा जाएगा, उसके बाद how far it goes below that is something that the numbers will tell. In fact, the trajectory of our assets will tell around the Q3 or Q4 of this financial year. If you were to ask me this question around the middle of Q4 of this financial year, I'll be probably able to give you a far more cogent answer. As of now, it's very difficult for me to give you an answer on that.
Fair enough. Maybe not say the extent of decline, but then would it be fair to think that F28 could be at least like a 2%, 2 to 2.2% number?
For modeling exercise, yeah, you can plug that in because that is what we are committed to. Between if we have said that by Q4 we are between 2 to 2.2%, then obviously in FY28, if we have to maintain our good performance, we have to be in that trajectory or lower, right? So. For your modeling purpose, you can plug that number in. Right? But in Q4, please meet me. I will give you a far more nuanced answer at that point in time.
Sure, definitely. Thank you so much, and all the best.
Thanks.
Thank you. Next question comes from the line of Shripal Doshi with Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. My question was in continuation with the previous participants, wherein if the cost of fund is likely to go up because of the uncertainties. what is the kind of NIM implication that we see could happen? I understand that you highlighted the uncertainties around and the volatility around, but then what is it that we are sort of building in terms of the range that it could be in terms of implications?
So Shripal, Sachin here. In terms of NIM implications, we stick to the corridor of 10 to 10.5%, which we have given. There are different moving parts. Every quarter you will at times find the cost of funds going up or down. The yields now have come to a level where depending on which business we really accelerate, the mix now decides on what is the kind of yield movement that we will see. There is only one asset book which actually has a variable interest rate where we could pass on if there is an interest rate, which is mortgages. But apart from that, there are a couple of levers in terms of the fee income, which can also be looked at. And as Sudipta was mentioning earlier, that we are working on the payments platform. We should start seeing some, revenue flows, although we have not factored in at this point of time. But we from the next financial year, we are surely going to see some revenue flows coming in. So there are some moving parts. As the situation comes over, we will try to figure out how to deal with that. But the NIMs, you can stay assured that if you looked at last almost 2.5-3 years, we have been giving a guidance and we have stuck by that guidance.
Mm-hmm. Got it. So just a follow-up there. Since we talked about the loan book mix, we have seen urban book gaining share in the overall loan book. So where do you see the mix shaping up? While we've been talking about FY28, 27 and then 28 end, where do you see this this parameter in terms of the loan book mix shaping up by FY27 end and then FY28 end?
So just since this is a question immediately coming after the earlier one, the gold loan book is going to be one of the thrust area. Micro LAP will be another area. Personal loans will be a third area. And if you look at all these three are reasonably high yielding products, and we should be in a position to use these levers. And also as far as the microfinance, the rural business loan book is concerned, we are already at 99.8% collection efficiency. So we are not talking about decelerating the growth. We are just talking about in percentage terms, just because other books will grow, this may go down to some extent, but otherwise growth over there also will continue. So that's the reason I said there are levers of ensuring that the 10 to 10.5% corridor can be met depending on which business we accelerate in a particular quarter.
Got it, sir. Got it. Thank you so much, sir, for answering my questions, and good luck for the next quarter.
Thank you.
Thank you. Next question comes from the line of Piran Engineer, CLSA. Please go ahead.
Yeah. Hi, team. Thank you for taking my question and congrats on the quarter. Just a couple of questions. These large digital partners you work with for the personal loan business, do they also provide FLDG? And if so, how much?
No, we don't work on an FLDG model with any one of them. So it's completely our own credit. So see, at times working on FLDG models means compromising on credit parameters for the sake of volumes. With the philosophy, we don't do that, right? So it is only we originate customers at our own credit terms and not at terms of our partners.
Understood.
So we give an origination fee to the partner, nothing else.
Got it. And secondly, sir, did you mention in your opening comment something about CGFMU?
Yeah.
How much
we have started taking CGFMU coverage for our microfinance portfolio, especially. See, we have not taken it for 100% of our portfolio. So we have done a sort of risk matrix analysis, and we are taking coverage on a certain section of our portfolio. The portfolio we think that are more prone to or softer portfolios which we think are prone to economic shocks or has some overhang of an event risk. That is where we are taking this coverage. Just like we are taking CGFMU, we are taking CGTMSE coverage for our SME business as well. Again, not on the entire SME book, the cohort of the SME book that we think it is risky. So when we underwrite our SME book through Cyclops, it divides the book into three segments. The segments which you call premium, core, and value, and they are rank ordered according to their risk. It is only primarily in the value segment, which is the lowest of the cohort, that we are taking CGTMSE coverage, because that we consider as a sort of a vulnerable segment as well. So again, our objective of taking the CGTMSE coverage as well as the CGFMU coverage is to provide the optimum amount of protection with the least amount of addition to ongoing OPEX.
Got it. But sir, sorry, in MFI, how do you what sort of, can you give an example of a cohort? Like, would it be only borrowers with more than
It's difficult to give an example of a cohort, but let me give you an example. It's because each and every state has its own flavor. But there might be one particular state which is more prone to floods, right? Now there are two options. You can take CGFMU coverage, or you can take parametric insurance, right? Or all new customers, for example, right? Any new customer who is coming, all new to credit customer. You have not seen their credit behavior before. They are completely zero cycle, right? So those are the customers you would like to take a CGFMU coverage. Now once those customers go through 3 years, right, and has done 1 or 2 cycles with you, you are good enough, you know their coverage, so you're happy to let go of the CGFMU coverage because you know that this customer is credit seasoned, right? Also, we are moving around expanding our business in new geographies like Rajasthan, Punjab, Haryana, MP, Gujarat, Maharashtra, Orissa. These are the locations where we are taking CGFMU coverage because many of the customers that we are acquiring in these locations are first-time customers for them.
Just to add, since we are taking it for the first time, in this year itself, we will cover about 35 to 40% of the total disbursement that we make in the current year for the microfinance customers.
Yeah, microfinance customers.
Understood. Okay, this is pretty useful. Thank you, and wish you all the best.
Thank you so much.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I now hand the conference over to Mr. Sudipta Roy for closing comments.
Thank you so much for joining the call, and thank you for your feedback and participation. I trust we have been able to address all your queries. However, I think that such a short time frame is probably at times inadequate to address all the queries. So our investor relations team is always available to answer any queries, and myself and my management team are always available to meet you one-on-one or in groups to answer any additional queries that you might have. Thank you for your participation and attendance. And with this, I would like to close the earnings call for Q1 FY27. Thank you so much and have a nice day.
Thank you. On behalf of L&T Finance Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.